What's next for markets?
Hello, I'm Stephen Gregory. I head the quantitative research effort, Piper Sandler. I'm filling in this week for Michael Kantorowicz. I'm joined here today by Emily Needell, who is the Deputy Chief Investment Strategist at Piper Sandler.
Hello, Emily. We're wrapping up third quarter earnings. We have 6 of the 7 Mag 7 already reporting. We're just waiting on NVIDIA. And so far, earnings season's been pretty good, but you turn on CNBC, you look at the headlines, Mag 7 still dominating. Everybody wants to talk about them. They seem to, you just can't escape the gravitational pull of those 7 names.
That has been the theme of the last couple of years. Everybody loves talking about the Mag 7. You really can't escape it, from client conversations to cocktail party conversations. The Mag 7 has just continued to gain attention. And I think, to your point, the big keep getting bigger. And if we look at the Mag 7 performance this year, again, we've got 2 of the Mag 7, NVIDIA and Google, up about 50% year to date, which is obviously a huge number, and especially unbelievable, and especially impressive when you think about the size of those stocks to begin with, and then rising another 50% is just unprecedented. And we all know that the returns for these Mag 7 names have been crazy. It's something we've all been talking about for years. But when I recently pulled just the 10-year returns of those 7 stocks, just to see what those numbers actually were, I was pretty shocked. Did not realize, I don't know if you were to guess what the NVIDIA's return would have been over the last 10 years since 2015, I would not have guessed that it is up over 40,000%, which it almost seems comical. And of course, NVIDIA has done better than any of the other Mag 7 over that 10-year period, but all of them are very impressive. From NVIDIA, which is the best over the last 10 years, down to Meta, which is the least return over the last 10 years, is still up a whopping 700+% compared to the S&P 500, up 230%. So the returns, obviously, this is why people love talking about them. They're just so impressive. So many success stories of people that have invested in them. And it's just been something that, investors just can't escape from. Mag 7 is really taken over the conversation in just so many different ways at this point.
Those are incredible numbers. I would not have guessed any of them. It's pretty amazing. I know one begets the other. The return is obviously an increase in market value. And as such, if you're outperforming, your weight would be increasing. But over the last couple of years of just unbelievable return, while already at or near the top, has just created this unbelievable, everyone wants to throw on, bifurcation between the Mag 7 and the rest. It's just truly astonishing.
Yeah, that's absolutely true. And just thinking again about the size of the Mag 7, the size of each one in market cap is essentially an entire country's market cap. I mean, we did last week, we threw together a table that looked at, we ranked across the world countries by market cap, and we threw in those Mag 7 stocks into the mix. And you have, of the largest top 25 regions in the world in terms of market cap, the Mag 7, if they were their own entity, would have fallen into that list. And actually, NVIDIA, Microsoft, and Apple would be the top 10. In between India and Canada's market cap, you have those 3 names.
So those 3 stocks on their own are larger than the entire market cap of the equity space in those countries.
That is correct.
The unbelievable facts continue.
Right. This is why it's so much fun to talk about. It's astounding. And again, we all know how big they are, but when you quantify it in this way, it really just brings it home as far as how much the dynamic of the market has changed, that we're at a place now where just a few names are making up have such a huge impact on the investors' space for anyone that's investing in U.S. equities at this point.
You have huge returns with already huge weights and dominating the S&P 500. So what are the ramifications for that for other equities? How do you compete with that? Is this just this new market dynamic? Like, I imagine the distortion underneath the surface is just incredible with those numbers you're giving.
Oh, yeah, absolutely. Again, looking at those, if we were to look at the top 10 stocks in terms of size in the S&P 500, they now make up 40% of the S&P 500 index, 40% from just 10 stocks. And so they are causing a crazy distortion because not only do those stocks have a bigger weight and we're more concentrated now at the top than we ever were before, but those stocks are also having such crazy strong returns. And so what we're seeing, and we've been seeing this for several years now, is the worst market breadth in history in terms of stocks that are able to outperform the index. So looking back for just the last 3 years, for example, the past 3 years, we have not seen in any of those years more than 40% of stocks beating the index. So most stocks are underperforming the index. That's been the case for the last 3 years. And if you look at those past 3 years, on average, only a third are even keeping up with the index. So we've really been in a backdrop where it has just been a very select few that are able to keep up and beat the index. If we're looking at the S&P 500 cap weighted, which is what so many people do. And so this is bringing up the question and changing potentially the dynamic of what does it even mean to outperform?
That's a great way to phrase it instead of bifurcation or distortion, because they make up 40%, you said, of the S&P 500. What does it really mean to outperform if they're just so much of the index? That's really interesting. I like how you framed that there.
Yeah, I think people are having to adjust the way that they answer that question is, am I outperforming or not? And I think to give a concrete example to that, let's look at one of these Mag 7 names. It's up year to date, Amazon. It's up, give or take 13% year to date, which is better than the year to date return of your average S&P 500 stock. If you look at all the S&P 500 stocks, on average, you're up about 8%. And if you look at the equally weighted S&P 500 index, that's up about 6%. So Amazon is beating both of those metrics, but it's lagging the S&P 500. So is that good or bad? Would you be happy with that performance as an investor? And I think that question has really become something that investors need to consider in a different way than we used to when it was all just about beating the cap-weighted indices, which were much more diversified than where we are today.
That's interesting. That is a great way to think about it. And it's just what really is outperforming and what are we trying to get at? And for a lot of these Mag 7 stocks that are making up such a big weight, you have standouts like NVIDIA, which is just a runaway success. But for the rest of the Mag 7, how do you outperform yourself if you're such a large weight of the index?
Yeah, it's a great question. And also, you're seeing so many areas of the market underperforming, and putting quotes around it, because they're lagging the S&P 500. And we've done some work looking at value as an index's relative performance, and looking at financials and industrials, which have underperformed the S&P 500 overall. But if you compare their performance to the equal weighted index, those sectors are doing just fine and actually been doing well over the last couple of years. So it really is all about, in terms of the relative performance story, I think we're all taking a look at what are we really using as the benchmark? What's the most appropriate, given that this dynamic has shifted? And I don't think there's any right answer yet at this point. We're all still living through this, but certainly I think the concept of relative performance needs to be addressed in terms of what does it really mean to outperform and underperform in this backdrop where, again, you've got such a small handful of stocks that are just steering the ship at this point.
So, Emily, the stocks have gotten so big, and I know that there's a secular story behind their growth. You have AI and automation, all of these trends for tomorrow. And they're also companies that make a ton of money. So they have incredible earnings and great profitability. What are some other things that people talk about in terms of this story of what's driving it beyond the fundamentals? What are you hearing from clients?
Recently, we've been hearing quite a bit about the surge in passive funds and the influence that may be having on these mega cap names. And so the whole concept is that assets in passive funds, mutual funds, and ETFs has surged. We actually saw right around COVID period in 2020 that the assets in passive funds exceeded the assets in active funds for the first time. And so the idea is that these mega cap names are in so many different passive funds, and that as people pile money into those funds, that's really boosting performance and the size of those stocks. And I think that there is certainly some validity to that, in a sense that we actually took a look to see how many ETFs each of those Mag 7 stocks are in. And the numbers are high. NVIDIA, for example, if you look at how many ETFs NVIDIA is in, it's 1,675 ETFs.
Wow.
That's quite a few. And that's more than any other stock in the S&P 500. And the other Max 7 names are just behind NVIDIA at the top of the list in terms of number of ETFs that they're in. If you look over the entire S&P 500, on average, the average number of ETFs that a stock is in is 600 ETFs. And then you've got NVIDIA that's in 1,575. So obviously in way more ETFs than your average stock is. And the other Max 7 names are also, like I said, at the top of that list. They're all in at least 1,100 different ETFs.
I think it's a really interesting way to look at it because there's a lot of debate on, does it favor large caps more? Does it favor small caps more? Does it hurt large caps more? Does it hurt small caps more? And you can make the bull bear case around passive for the size trade. But when what you're talking about is just the number of funds involved, which now you're getting into the crowding. How many people are cramming into that theater? And at 1,600, you said, ETFs involved in NVIDIA, that's a lot of ETFs invested in that name that have potential flows constantly reinvesting at some defined weight. So Emily, that's definitely the whole passive contribution debate. What are some tangible fundamentals that these are actual numbers that we can feel and touch that highlight how much or how little these stocks are actually contributing to the overall index?
Yeah, so that's a great question. If you look specifically at the earnings contribution from the Mag 7 names, about $76 of the S&P earnings number, it comes just from those stocks, which is obviously an enormous number and has contributed a lot to the overall earnings growth for the index. Also, if you look at margins, for example, if you look at operating margins for those Mag 7 names, they have surged and they've really contributed to the S&P 500's index having all-time high in its operating margin. Without those 7 names, you would not see the S&P 500's operating margin at a new high today. You've got really strong earnings, really strong margins. It's got incredible fundamentals that are driving its performance. And it also begets the conversation, unlike every other segment of the market, valuation. So large, mid, and small caps, if we look back over the last couple of years, all of those areas of the market have seen PE expansion. Let's say we go back to benchmark back to 2022, you've seen PE expansion in every segment, so size-wise. The Mag 7 PE is actually down since 2022, which I think a lot of people would be pretty surprised by.
That is surprising. I am surprised by that.
Yeah, it's pretty surprising. And so the strength that we've seen in those sectors, the earnings have been an incredible growth story. And so it's not as though we're seeing these crazy valuations in these stocks that continues to surge. It really has been, the earnings are there. And I think, again, going back to that $76 of S&P earnings, the earnings are there, the profitability is there, the margins are there. So it's really been a pretty validated. I mean, the performance has obviously been wild, but so has their growth stories.
Yeah, the margins is definitely interesting. Large cap margins, I did know, were at all-time highs. And that's been such a contrast to a lot of other parts of the market. Small cap margins have continued to decline in a backdrop where growth is good, but it's not really accelerating for a large portion of the economy. So to see that it's not large versus small necessarily, it's Mag 7 versus everyone else when it comes to the margin story, which is such a big driver behind performance.
And I think that certainly has been a Mag 7 versus everyone else story.
So Emily, I have to ask the question. One of the Piper Sandler portfolio strategy team's calls has been better breadth ahead, potentially into 2026. Given all the things we just talked about with this, what does outperforming even mean these days? What does that mean? Better breadth ahead. How are you thinking about that?
Yeah, that's a very fair question. I'm glad you asked it. Yes, on the strategy team, we do expect that we are at a turning point in the cycle where we are now seeing the lagged effects of stimulus, of lower rates should boost economic growth from here. We watch things like PMIs and housing, which have been very stagnant and kind of range bound for the last couple of years. And so we've been in a bifurcated world for about 3 years. And in that 3-year period, we've seen breadth that's been very narrow. As I mentioned earlier, there's not that many stocks that have been able to keep up or beat the index. And so we do think that as we see a reacceleration in the economy from here, you're going to start to see more stocks benefit. The more cyclical areas of the market should get a boost in terms of this better growth that we're beginning to see and that we expect to see over the next few quarters. But the Mag 7 is a story we don't think is going away. So we do think that breadth will improve from what we've seen over the last couple of years. But we don't necessarily think that it's time to sell the Mag 7 and that those stocks are in for a rough ride ahead. We do just think that other areas of the market should be better able to keep up as we go through this period ahead where we're likely to see stronger data and a reacceleration in the economy.
So, Emily, what you're talking about is a better backdrop for a lot of equities, but not necessarily a light switch where was the Mag 7 and now it has to be this.
Yes, that's exactly the way that we're thinking about it. We're not expecting a light switch kind of situation where everything that was working is now not working and everything that was lagging is doing better. We're just saying that we're likely to see improving breadth compared to what we've seen over the last couple of years. And actually, I think it was interesting last quarter when we did our quarterly recap, the best segments of the market in the third quarter were large growth and small value, which in itself is an unusual dynamic to see opposite areas of the market outperforming. But in that sense, we were starting to see cyclical areas of the market do well. At the same time, we were seeing Mag 7 continue to do well. And so I think that we are expecting to see continued outperformance of those mega cap strength names, but also other areas begin to do a better job of keeping up.
Great. Really interesting. Thanks for your time. I definitely learned a lot and have a lot of fun facts to take away with me.
Yes, you're ready now for a Saturday night cocktail party, Stephen.
Yes, absolutely. Thanks so much.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.